Good morning. Good morning. Good morning. How are you this morning? Where does that come from now so suddenly? Good morning. Welcome back to another live show this morning, number 41. 41 in 41 days. I'm really starting to get very proud of what we have done here, and I can't do it without your help. So thank you very much. Today, we're going to talk a little bit more about investments, the current sort of landscape that we find ourselves in, the risks, the opportunities, and a whole host of other things. I've got a special guest, so you know that if you see my headphones, it means that I've got a guest on. So I'm very, very grateful for Roeloff for joining me this morning, and I'll introduce him to you in a second. You may have had a very quick glimpse of him in the beginning as we started the broadcast. So yeah, very excited about this. I've got a whole host of questions I want to ask him and that I want to talk about. Half the stuff he doesn't know what I want to ask. So, you know, keep them on their toes, they say. But from my side, welcome. Very happy to have you here this morning. Let me quickly run on over here. Let me just get the LinkedIn feed going so that we can, so that I can interact with you. And I want to start with LinkedIn this morning. I've started with YouTube the last while, so let me start on over on LinkedIn with my friends over there. Neil Phillips, good morning. Hugo Blom, good morning. Cape Town in the house already. Henny Bauer, good morning. Hope you're going to enjoy this one, Henny. Greg Stockton, nice to have you here, Greg. Nice to see you. How's it going there in Dubai, right? I don't know what's happening now this morning. Stefan Mathieu, goeiemôre Stefan, welkom terug. Jaco van Skalkwyk, nice om jou hier so te hê. Innocent, very nice to see you here once more. So we're planning a follow-up, by the way, on the work from home session that we did. We want to sort of start looking at what happens after this, so I'll announce that as well. So me and Innocent needs to compare notes, and then we'll be off on that. Then Johan Forster, Johan, welcome this morning. Thank you very much for joining us again. Stefan Leroux, baie welkom terug. Môre 41 strong, yes. Hey, it's really nice feeling. Greg, yeah, we can have a chat. If you want to join, we can definitely have a chat. I watched the hangout you had with Ryan Stramroot the other day. What was it, the Sunday, I think, or Saturday, and I would be happy to chat to you. Francis, good morning, Francis. Nice to have you here. Peter Strydom, welcome back. And then Fatu, is it? Fatu, good morning. It's the first time I've seen you here. A special welcome to you. Thank you very much for joining us. I appreciate it. And then over on YouTube, you know now by now, Mr. TT goes, good morning. And I would have added Vietnam if I could. But good morning. And Kobus Klein, welcome back, Kobus. Nice to have you here once again. 41 out of 41. You know, it's really, really special. Is there anybody else that have been here like every single episode live? So not necessarily that you maybe watched everything, but you watched the recording. But is there anyone else that has been here 41 out of 41 episodes for the live episodes while we were live? I will really want to say thank you to you. So if I missed that, it's hard between everything. So, you know, the first people that tend to comment always, you would know that. But as we go through, it's hard to remember was everybody there or not. But I would really want to say thank you to you. So please let me know. Who else have we got? Denise, good morning. Welcome back, Denise. Nice to have you here once more. Casper, welcome back. You're now becoming a regular, Casper. Thank you very much. Khomotso, you as well. Thank you very much. Welcome back. Nice to have you here again. Good morning, Razan. Welcome back. Nice to have you. Then Raymond in South Broom. Welcome, Raymond. Raymond, do you play golf, by the way? That beautiful, like, golf course you've got there. Let me know. And Raymond Visser, môre Raymond. Welcome terug. Elmien Lottering. Elmien, you are way beyond being a regular. So thank you very much for everything. And Malcolm, you as well. Malcolm, did you see we're on 322 this morning? So some nice growth, although the day before we didn't really grow. So yesterday we had quite a lot of subscribers being added. So thank you to everyone that has subscribed. Kevin, good morning. Kevin, you're also now getting your regular badge. Thank you very much. Stephen, Nell, you as well. Baldu, ek dink is die eerste keer wat ek jou sien, maar ek weet hoekom jy hier is. So, is reg. Welkom. Nice om jou hier so te hê. Dan Tinus Brits en Bloem. Tinus, goeiemôre. Welkom terug. Martina, good morning, Martina. I haven't seen you here in a while. So thank you very much for being here. Welcome back. Ian McMaster, good morning, Ian. Also a regular. Bongi, also a regular. Thank you so much. Malcolm, good morning. Francois, everyone. Good morning. Good morning. Renee, good morning, Renee. Nice to have you back here as well. And then Kuketsu, Kuketsu, welcome. You also now becoming a regular. Gary Walker, nice to have you here, sir. Nice one. I haven't seen you here in a while. And then Arun, I've missed you for a couple of days, Arun. I hope you received your email about the tax tool. So you've been asking me a lot, and it is available. So I hope you received your email and that everything is well on your side. I always get worried when I don't see people for a couple of days. Is everybody okay? And, all that good stuff. By now, please interact, okay, with one another and with us. Please send me your questions. If you can send me your questions via WhatsApp, if you want to ask Roeloff something specific, maybe as we get into the conversation this morning, you'll see where we're going with this, and that, it makes sense. Then there may be some questions that come up. Please WhatsApp them to me so that I can look at them and then add them to the conversation and when we have time. I would gladly do that. Then please give us some love, like us, share us, tell everybody about us if you feel that you're getting value from this. If you don't feel you're getting value, please then don't do that. But if you feel that you're getting value from what we're doing, you want to help us out, please help us get the word out there. It means a lot to me. Thank you very much. And then remember to subscribe or connect with me. So if you're on YouTube, please subscribe to the channel. If you're over on LinkedIn, by now, please, you're welcome to connect with me. And let me quickly run back to LinkedIn before we get started. There's lots that I want to talk to Roeloff about. Chart, good morning. Welcome back. George Dell. First time I've seen you here, George. I also know why you're here, because you're all part of the same team. Frans Hatting. Good morning, Frans. Nice to have you here. Greg. Yes, I'll check. Morning. Oh, people saying morning to each other. I love that. Please say morning to each other as well. Yeah, that's fantastic. That's what we're all about. All right, just some quick things. I wanted to share something with you this morning, but I couldn't get it up in time to sort of share that with you, but maybe I'll do that tomorrow. But I do want to tell you, this morning, this is one of the best things about having things online and automated to some degree, that so everybody that's renewing the tax tool at the moment, this morning I received another one that said, okay, obviously there's an order and payment was received and all of that, but when you place your order, there's a place to put a note, and this particular person put a note there to say, thank you very much for the discount, because we give a 40% discount to people who renew. And he said, thank you for the discount. This tool just, is worth way more than that, basically. But I want to show it. I wanted to show you it because the way he put it was quite awesome. But that's the kind of stuff that puts a smile on my face. So thank you very much for that. I'm not going to mention your name because I didn't ask your permission, but I did want to show you sort of just what he said. But anyway, so yeah, just two quick things. Please, the business assurance refresher. There's still space. Why is there still space? Well, why is there limited space? Because my Zoom webinar software only allows 100 people in. So once we get to 100, then there's no more space. So we do have some more spots left. You can still book. It's only $350. Okay, if you're an Ignite member, you're only going to pay 300 Rand. If you're not an Ignite member, but you are a Profile Me client, then you will only pay 315. So that's still a bargain. And you'll get CPD thrown in. How awesome is that? So really, really awesome. Please join us for this. You can see there let me just take my own words here off the screen. So you can go to francoisdutoit.co.za, online refresher. So do that and register today. Don't wait. It's really, this is the best time for you to make sure that your knowledge is updated. Even if you don't need the CPD, this isn't about CPD. None of the stuff that I do is about CPD. It's about sharpening your blade. It's about being the best that you can be. It's about unlocking opportunities. It is about really putting the client first and being able to grow your business, but also then to make sure that your clients can achieve whatever it is that they're setting out to achieve. And that is what I'm about. It's what my business is about. So please join me for this. It's really going to be filled with some gems, things that we're going to talk about that people don't always talk about. And it's going to be focused on the most important stuff. So we're not going to talk about fluff. We're going to talk about the most important stuff. So please join me for that. And then the tax tool, as I said, is available now. I'm not going to get into it now. You can get a free trial of that. You can just go to francoisdutoit.co.za/tax tool, and it will take you to the page, and there you can see what it's all about. And that's sort of my story. So on that point, let me get going. It's my privilege this morning to welcome Roeloff Horne. Roeloff is the director and head of portfolio management at MitonOptimal, and I'm really happy to have him here. Roeloff, welcome to the show.
Good morning to everybody on YouTube and LinkedIn. Very privileged to be involved in your show, Francois.
Thank you very much, Roeloff. I really appreciate it. Can you, in 2 minutes, give us a little bit of a background on who you are and who MitonOptimal is and what it is that you do?
I'm Roeloff Horne. As you can see in my background here, I love golf and cycling, which I can't do at the moment. So I'm working more than ever before. Valdo and George, that's part of our sales team, is keeping me very busy. What we do, we discretionary fund managers. And that means we service financial advisors to assist them to build portfolios tailor-made for their practice, or for those that just want to use our normal managed models. We have a whole range from low-risk income to high-growth portfolios locally as well as globally. We are an international business. We're an international business. We're looking after about 18 billion rand of assets globally. About just over a third of that's managed from South Africa, which is my responsibility. So we have our own funds and we have our own portfolios, which our advisors subscribe to. But we are, I would say, a smaller boutique discretionary fund manager where we really make sure that the advisor we service, that his needs are covered in terms of what he and his clients need. So that's what we do. Rand-based portfolios, dollar-based portfolios. We believe in diversification over the long term. And yes, our returns has been phenomenal on a relative basis over the last 1, 3, and 5 years. Many of our funds are first quartile. We've been very fortunate to be well positioned for the current scenario. But as with golf, you're as good as your last shot. Tomorrow is another day. So we've got to be prudent and do the right thing for clients and advisors. So that's who we are. Hope that satisfies your needs, Francois.
Yeah, great stuff. Thank you very much, Roeloff. Yeah, and I think we're really in interesting times. Some people say it's unprecedented times. But I think there's maybe been a lot of times in the past where things were, at that point in time, it was also unprecedented, and it was the worst thing that ever happened, and nobody knew what was going to happen, and nobody sort of had an idea of what to do, really. And you always have these sort of two camps about, on the one hand, people will say, you know what, no, this is what's going to happen after all of this is over. And then there's people that say, no, things have changed forever. And then there's people that say, well, things will go back to the way it was. And I think that the real honest fact is that we don't know. Time will tell. We live it day by day and we'll see where things go. And it's amazing how, just by putting your predictions out there, you sort of like, people focus on you and you sort of, it's great. But I don't know if you can still sort of, what do you feel and what are you thinking about? And why I'm sort of leading with this, Roeloff, is I want to get into really about the principles of investing. In a few of my episodes recently, I was speaking about principles, and that principles, they stand the test of time. That's why they're called principles. So it's the things that you stick to. Doesn't matter what happens, they always work. You may approach it a little bit different, and you may have different tools at your disposal, but ultimately, principles are there. So my question to you is really, are these investment principles that we've been taught, like time in the market and, all that kind of stuff, invest for the long term, look at your costs, all of those things, do those principles still hold currently?
Francois, my answer is going to be yes, but I think the most important principle in terms of investing is really the power of compounding. I tell my own story to my young guys when they join our business, and that is that in my case, I left Sanlam after 10 years for 11 years and had a pension, and one of the wisest decisions I've made is to actually reinvest that pension in a retirement annuity. And I'm now at the ripe old age of 55. I'm actually slightly over it now, but that's amazing to see what 150,000 has become just by actually staying in the market for 30 odd years, or 25. So to me, the most important investment principle remains the power of compounding. And yes, diversification and time in the market, all these things play a very important role. But I'd like to actually, especially in the times that we live in now, because you as advisors probably had calls from clients saying, shouldn't we invest in Sasol now, or in Growth Point, or in If a government bonds giving you 13% at one time. And Dion Host from Credo shared a very, very good analogy the other day on email, and that's about the horse, the analogy of the one-horse bet. So he says, one of the founders of Oakmont, it's a big hedge fund in the US, mentioned to him that he one day spoke to a guy who's a big betting man, and he said, look, there's a horse race, and there's only going to be one horse in it. And the betting man said, well, then I can bet all my money on this one horse, because it's definitely going to win. So what happened is the race started, and the horse jumped the fence and never finished the race. So he lost all his money. And that analogy to me is what we face at the moment, because there's a lot of clients and advisors that are saying, shouldn't we buy gold now in these difficult times, or shouldn't we buy a government bond? Lots of retail clients are looking at the 11% return in the SA bond and saying, well, that's like free money for the next 5 years. Definitely certainty of income. And with all, and what I'm willing to say is that I think there's a lot of risk in each asset class. So don't bet on one asset class. And diversification is the cheapest way of insurance you can get, because you don't pay for it. You just combine a lot of assets. Over the long term, it works. I've been in the industry a long time. It does work. Even for me, now I can say it's worked over the last 30 years. But many clients don't have 30 years or 20 years. And I think what we sit with especially the behavior of investors is this instant gratification, and social media and internet has all created this hype of quick results and quick fixes. And this is exactly, I think, what COVID-19 can bring to us in the world, is to actually accept the good principles that the world actually provides you over time. Maybe we communicate better with our families in this time. Maybe we realize how awesome nature is in this time, and that just to sit and breathe and actually communicate properly. And that the same with investments. Maybe people will realize that you have to have an emergency cash provision in your planning. You've got to actually invest for the long term, because you need to have capital when you retire. Many people, as we know, didn't save enough over time. And that's a big problem for us in the industry and with advisors, where we're not actually, most of the clients haven't provided enough for their income. And now we're facing with demands of 8 to 10 to 12% per annum, while the returns that we get globally and locally, soon 4%, 5% money market, is going to put those clients at a massive amount of risk. So coming back to your question, I think investment principles still apply. And what I've continued to learn in this environment, especially with social media and internet and all the information we get, is that one's conviction on economic fundamentals of a stock or asset class, one should respect the trend and momentum of each asset class or security and act accordingly. So momentum and trends is something that you need to respect a lot more in this current environment, because the speed of information actually generates these algos and these machines and the kids to react quicker, because they enjoy the trading and they create what you call it income for the investment bankers. So you need to respect that, and that's inherently hard, especially if you're a large asset manager. You can't actually do that. You can't move money around. So the new challenge we face is that with COVID-19, it will change the behavior of consumers and business. I think definitely in the next 12 months, maybe not over the next 5 to 10 years, because if they get a vaccine, it will go away and we will be more normal, as you mentioned. But I think in the next 12 months, one can expect a lot of behavioral changes. And what's always important, and this is a very important message to the advisors and clients, don't now look at past performance of certain securities or asset classes and funds. It's going forward, at least in the next 12 to 24 months, it will be about avoiding the companies that fail, avoiding distressed asset classes and disasters, and holding quality assets. I think that's a theme that's very important, especially in the long term, is that you ensure that you have quality asset classes and quality assets in your portfolio. So I'm not sure if I answered your question there, but I think over time, diversification and time in the market will definitely still prevail. Power of compounding is so strong. People that have continually invested on a rand cost averaging basis, they will get the reward over the long term. But the short term challenges will definitely be in clients who need income.
Yeah, no, definitely. So there's just two things I want to add before I get to the next section is there's the one big thing that I learned during this time, and you said that we learned that we need emergency funds and those kind of things, absolutely. But I also learned a very big lesson is that I don't need to spend money to be happy. Funny enough, if I look at what I haven't spent money on during the last bit and what we used to do before this, it's quite a I don't know how to say that. It's really like, to open my mind to like, whoa, you don't need this to do this kind of stuff as well. And if you don't do those things, there's so many other things that you can do with that money. And for me, that is really the thing is like you choose and often your money will show you where your values are. What are the things that you deem to be important? And that is what's so amazing about this time is that now we can consider our values and are these things really important to us that we've been doing. So money is a very big indicator of what you value. But that's on the one hand. The other thing is I attended a webinar yesterday and it's amazing how certain, call them asset classes or certain types of investments will beat their drum so hard now. Because of like, it's easy now to show, see how volatile the market is, see how much. And I looked at the markets this morning. I mean, we've recovered half of what we lost since this whole thing started, even a little bit more, it seems like. And then the rand is at about 18 rand 56 or something this morning. I don't know where we're now, but that's more or less where we are, but they will show how volatile it is. And then this is but they don't share all the risks that are involved. And they say we're low risk and they compare themselves to cash. And I had a call from a tax client of mine asking me about somebody that advised him to get government bonds because there's no risk. It's guaranteed. It's just, and I'm said like, really? If you think of where our government is at the moment, do you really think that it's completely risk-free and that 13% is so awesome? But the problem is I couldn't obviously advise or I could give him information, but I'm not a registered advisor or licensed advisor from that point. But anyway, I just wanted to add that to that point, Roeloff. And sort of the next thing I want to talk about is then, if these principles hold true and everything is, we should stick to those. And you also mentioned, which does make it difficult for some people where they don't have sufficient time. They don't have as much time as somebody else, for instance. And it depends on what that means and where you are in your journey, because sometimes I think we think that somebody who's now 3 years from retirement or they were going to retire this year, that they don't have time and they've still got 30 years or whatever in retirement. So they still have time. I think the thing that we think that people don't have time is not necessarily always that there, but when you get to the end of your life and you only have 3 years or 5 years, or you don't know actually, that one is very, very difficult. But then what I want to ask is, is there any value really in the market at the moment? Is there things that we can focus on? And is there value in actively seeking? You were mentioning Sasol. I know I've heard Sasol, Capitec, all sorts of different, things that one should look at. So is there value in actively seeking out those opportunities versus sticking to the principles?
It's a very tough question. Let me take you through call it a thinking pattern on opportunities available, because on the face value, you can go through each and every asset class and see a lot of opportunity based on either current price or current historic dividend yields or current historic earnings that was earned by a specific stock. So let's take the easy one, global technology, take a Microsoft, take a Amazon, or even an Alphabet. Their earnings are still good. It's growing by 20% per annum. The only thing, I think it was it Alphabet last night that earnings was confirmed that it actually stayed quite stable, but the advertising revenue has actually dropped a lot. And if you think about it, at the moment, people will still be active in all these social media, internet apps and gaming, and use of the mobile and actually YouTube and everything else. But maybe the companies that advertise that are damaged due to the short-term economic consequences of COVID-19. And by the way, it's the consequences of COVID-19 is the lockdowns and how it influences the economy. It's not how many people die. It's the influence of lockdowns that's actually affected the economies globally. So taking global tech, you look at, an opportunity, you compare that to SA bonds at 11%, 20% earnings growth and an average return of over 20% per annum. Looking at past performance, you say, well, that's a slam dunk. It's a quality company. You definitely should invest in it. And we agree that quality companies and those large caps will be a good investment even over the long term. But in the short run, the next 3 to 6 months, maybe their earnings will not be consistently generating a 20% return due to the ad revenue that's maybe going to be lower than expected. So that's tech companies. Now you look at SA property as an example. Take Growthpoint, Nepi Rock Castle as 2 examples of 2 quality companies in South Africa from a real estate perspective. They all have debt. If you look at the historic dividend yields, I think Growthpoint historic dividend yields now trading at about 16. So you look at 16%, what for Growthpoint? But is that dividend going to actually realize in the next 12 months? And the answer is no, because maybe they get 60% of their rental income from tenants, and maybe the cost of debt has increased a little bit. Remember, when you get downgraded like South Africa has, what it actually means is that your cost of debt is increasing. So you as a company or a corporate that need more capital, and you want to go to the market and actually issue a bond, the market's going to ask you ask you to pay a lot higher yield relative to the past. So the cost of capital for business has increased. So that doesn't have any relation to your money market rates at 4 or 5%. That's another subject coming.
Yeah.
So what I'm trying to say is, you look at two examples: technology globally and listed property locally. You look at the past and you think, but at the current price, this is a slam dunk. You should buy it. But it's what happens going forward in terms of the earnings. Same with SA government bonds. Maybe they can afford to pay in the short term 11% in terms of interest to investors. But with all the stimulus that they have now promised, it means they are borrowing money from an entity, whether it's the Chinese bankers, the BRIC banks, or whether it's money they get via the PIC, or whether they actually print money, where the Reserve Bank actually buys bonds. In the end, it needs to get paid. And if you look at any economy, it needs the tax receipts to actually increase. You've got to have a stronger economy to be able to repay your debt. Bottom line, doesn't matter which business or economy you drive. So the risk of South Africa, the ability of our government to actually pay all bondholders over 5 years or over 10 years to repay that capital is under pressure. There's no denying that. Then you go and take gold as an example. Okay, so now gold and dollars, that's 2 asset classes that we embraced over the last, actually since 2016, we've been investing in gold for different reasons. And dollars, when you're a South African investor, you should always have offshore exposure. So we've had both. It's expensive right now. You look at a graph of the gold price since 1991. The last 3 months, it's spiked like this. So it's expensive to buy gold in rands at the moment. It's expensive to buy dollars at the moment. So you've got to be careful. What I'm trying to say to advisors and to clients is to be careful just to find one horse and bet that this horse is going to actually provide you with the opportunity. Coming back to your question, is there value? For sure there is, but you need to be careful. You need to be actually holding quality companies that has very little debt, and that's got a quality business model, that's got pricing power in its ability to still generate the same kind of earnings of the past. And then lies the problem at the moment, is that analysts and economists are trying to determine the economic effect of earnings in each asset class. And from my personal perspective, it's tough to be able to tell you exactly what the value is at the moment. Therefore, we think there's definite opportunities in all of these asset classes, with the exception maybe of dollars and gold being very expensive. But from a South African perspective, I think it's always wise to have that diversification in those asset classes. It's a free insurance policy. But that there's opportunity in SA Inc., for sure, if we get this economy right. For sure, in banks and retailers, they are priced at the same level as the credit crisis. But the question is, will the earnings arrive in the same way it did post the credit crisis? And at the moment, that's not easy to tell. But globally, emerging markets are pricing or are trading at a discount to about 30 to 40% relative to the US. So it's cheap relative to the US. But that said, if you think about this entire stimulus, now, I mean, don't quote me on the number, because one day I read it's 5 trillion of stimulus, the next day it's 8 trillion of stimulus, who knows, but it's probably been between 6 and 8 trillion of stimulus or relief packages that's been provided between the Japanese, the Europeans, the UK and the US and some emerging markets. That underpin is very important to also understand that this could not be a complete risk-off scenario. That the problem with relief packages or stimulus is, does it find the right business and consumer in the end? And therein lies a bit of a challenge. I'm not convinced that it will find the right avenues consistently on a broad economic basis. But does it assist the economy? Yes, it will. Will it put a floor to the downside of many stock markets? Yes, it will. I don't think we will end up with another 50% downside from here. Maybe a correction of 10 or 15% is probably going to happen. If we take this analogy that we are in an equity bear market globally, which I think we are. I've got sort of a 60% probability that we are in a bear market. Well, technically we are, but are we going to continue to be in the bear market is the question. And I think the result will be, in terms of the economic results and the earnings results that we see over the next 3 months. So the next 3 months is going to be a very important indicator whether the global economy is healthy enough to stand up from this, call it, 2-month setback that we've had, and whether the cure for COVID-19 is going to be available fast enough. And then the risks of that will be the winter of the Europeans and the US coming, call it December, January. Will that maybe have a second wave of COVID-19? So my take on this is, yes, there's a lot of opportunity, there's a lot of value available, but you've got to be careful in terms of your long-term strategic benchmarks, where, let's call it a pension fund, call it a Reg 28 balance fund. Normally, to have a 45 to 50% SA equity component would be standard process, and maybe 25% international equities, and then you're close to your 75 maximum. Our view on that is, maybe you shouldn't be at that level under these circumstances because of the uncertainty of the E, whether it's from bonds or whether it's from equities. So you maybe have to have some cash available to use when there's more clarity in terms of the earnings, whether it's locally or whether it's globally. So we are at about 50% to 55% risk assets in that kind of portfolio, relative to a 75 to 90% potential. Because if you add listed property, SA listed property, you can actually have a 90% risk assets budget. Yep. So what we're just saying is, got to be careful here, and have enough cash available to use for opportunities that may actually appear if there's more downside in the market. And I certainly think what the recovery that you've talked about is a wonderful opportunity to reset your portfolio. That's what we've done. We've had actually a really good downside protection, and then got back into the markets between 19 and 30 March, and now we're just taking some profit from the table and saying, let's be careful from here. Let's diversify the portfolio appropriately. That even if we're wrong, i.e., the markets recover fully, we're back in a bull market, we will do our inflation plus 6 to 10%, because you still have risk assets in your portfolio. But I don't think it's the time to be aggressive in your allocation to risk assets. There's too many uncertainties from an earnings perspective, from an economic recovery perspective, whether it's globally or locally. So there's a lot of value on the face of it, but you've got to be careful because some assets are actually priced to perfection. Gold is expensive, dollars is expensive. I'm talking in rands. But maybe what we need is a rand to recover back to 1750, and then we can actually get back into those asset classes again. But you shouldn't look at past performance and invest behind it. It's really my message. So don't look at your dollar funds and your gold funds and say, yo, it's done so well, now I must invest in this. I certainly believe gold has got to be part of your portfolio for the next 5 to 10 years. There's inflation coming up. All the stimulus that's been provided globally, the central bankers and even the people that's been responsible for economies over the last 10 years haven't seen inflation. They don't know what it is. And especially if you think about many economies like maybe the US or developed markets will say, listen, my production line's got to get out of China now, get out of the East, bring it back to the US, typically the Trump analogy of make America great, that will come at a cost. So production costs will be higher, and that brings inflation to the game. Whether they use robotics or not, it will be at a higher cost. So gold is a great protector in terms of inflation going forward. So we're not contrarian investors. We don't say gold's the only asset you should hold, but it's a nice diversifying your portfolio, and so is your dollars from an SA perspective. But there's value, but there's a lot of risks. So you need to be guided by a portfolio manager in this regard.
Yeah, and my next question was, how do we balance it? But I think you answered both of those in detail, because it is about, you shouldn't, look at where we've been and what the past has been. It's where we are and understanding what could happen next, etc. So those are definitely. So I think you already answered. My next thing was going to about how do we balance risk and opportunity, but I think you answered that, Roeloff. So
but ask me that question. I think it's very important because I want to address the advisor's role here. The financial advisor is the most important cog in the wheel for the client. That's why he deserves or she deserves to get the biggest chunk of the fees in the industry, because they, together with the client, must understand what the client's long-term investment goals are, what their risk capacity and risk budget really involves, and therefore create the appropriate portfolio for that client to stick to maybe an emergency cash plan, to stick to an income portfolio that's got to be managed in that way, and to then have the growth portfolio available for the long term. And then to manage that expectation to the client will mean that there will be less pressure from the clients to say, should we switch from this to that? If you coach your client to say, this is your emergency cash, this is your income pot, and that's your growth pot, your asset manager, your discretionary fund manager, your advisor can actually then have less stress in terms of the expectations for the client. So that's if the advisor do that job well and communicate, especially in tough times like these, to clients will sit, and we have seen that. I've worked with advisors for the last 35 years, and most of those that are subscribed to us for the last 15, 20 years tell me that the clients are all understanding of the situation at the moment. And but I say that, but I think the challenge locally will become even more income generation. It's a fact that money market rates will come down to between 4 and 5%. And those clients in living annuities, or those clients that need income at 8 or 10%, they have no choice but to assume risk or change their lifestyle, like Francois. Buy less, stay at home more, spend less, do not use alcohol, do not smoke. That's the real alternatives. And that's where the advisor's role to the client is so important, to coach the client and to agree to an investment plan for all those 3 facets that I've mentioned. And within that, then your asset manager's got free rein to operate within that mandate and to use the opportunity within the risk budget provided to the fund manager in the fund or portfolio that is made available.
Cool. In this time, and I've obviously speak to a lot of advisors, but one of the things that I sort of found that a lot of clients, a lot of the questions that they fielded around this was about, I want to get out, I want to switch my portfolios, I want to move, just move me into cash, just do this. And now I go back to my very first question around principles, which means now, should we do this or should we not? And I think there's a big danger because that becomes timing the market. Because now you say, getting into gold is now, it's almost too late. It's not to say, but it is definitely, you're not going to get the same kind of returns of people who's been in gold when it wasn't going so well with gold before, because by the time we realize that an asset class is doing well, it's done most of its growth usually. But from a switching point of view or move my portfolio or cash in my investment or move to cash, I think a lot of advisors are, and I've had like big FSPs phone and say, you know what, our advisors don't know how to have these conversations with clients. They feel uncomfortable. They don't know how to guide them. Do you have any advice in that sort of sphere where, how do we talk clients through, what they should do and that, how do we have those conversations with them or should they be switching?
20-second commercial. The short answer is advisors should have a discretionary fund manager to assist them with these decisions and to help them build a storyline to understand where the clients should be invested in, whether it's a specific fund or a specific asset class. So that's my commercial. But let me give you the real reason why that's very important from an IFA perspective. I want to challenge all the advisors on this call to go and look at the asset allocation of funds that's done well over the last 3 years or 5 years, the current asset allocation. And I will name a few, and you may know Investec Manage or 91 Manage, Gail Daniel. You will know Resco Value Trend, Resco Manage Plus, or even Stable has done reasonably well. 36-1 maybe has done well. I'm talking Rec 28 Solutions just to make it easy from a comparison perspective. Go and look at the asset allocation right now. I'm not saying they're wrong. In fact, they are forming probably 30-40% of our current solutions in that space. So, but what happens is you simply look at a fund that's done well and you invest in it because it's maybe repeatable. But what you've done, if you switch from the Coronation Fund or an Allan Gray Fund or Prudential Fund to any of those three funds, you have made a massive asset allocation call. The Coronations, Allan Grays have between 40 and 45% in SA equities. The other managers that I've mentioned are between 5 and 30. Take your pick. So what you're doing is you're saying to your client, listen, I've had enough of the large manager, which is an analogy, it's acceptable. I've had enough of these oaks that they're actually just buying the market. They can't be flexible. These other three oaks, they can be flexible. And you make a switch to those managers. So what you've done is you've made a massive asset allocation call, which can be completely right. I'm not saying it's wrong. The expectation, however, from the FSCA and phase right now is that you have an investment philosophy that needs to be available for the FSCA when they expect you. They don't do that anymore, so people don't worry about it. But should you make that call and it's wrong, you need to have an investment process that supports that. And the same goes for the question in terms of switching. You need to document why you and the client have actually switched from Fund A to Fund B or from one asset class to another. And in my humble opinion, you need to have a team behind you to assist you in that decision, whether it's economic support or analysts or fund managers or specialists. You've got to have support to assist you with that decision. The last thing about switching is that it's important to understand that the next 3 to 5 years may be different, especially in the next year, and that your fund manager, whether it's your fund or your discretionary portfolio manager that you appoint, are flexible in their approach and the investment philosophy. I'm of humble opinion, and that's a personal opinion, not a MitonOptimal one, is that there's certain investment philosophies and certain fund managers that are so married to that investment philosophy, and that they should consider in this new world to change that investment philosophy. Otherwise, they will fail. And they will lose assets continuously, and that investment philosophy may not actually work. And there's a few examples locally and globally that I can name, but that's not my job. All I'm saying is that your job as financial advisor is becoming harder to understand the difference in investment philosophies between fund managers, between the asset classes they use, and the ability to actually use those opportunities. So second, commercial, get yourself a discretionary fund manager. It doesn't have to be MitonOptimal to assist you in those decisions, to assist you in making the process seamless, to be able to actually communicate that to your clients with a lot more credence behind you and a lot more confidence for the client to believe that it's the right thing. So yeah, I hope that answers your question, Francois. It's a tough one. It's a tough one.
It is. It is a very tough one, and I know I won't say it's an unfair question because it's questions that everybody's asking. It's just it's a very hard question to really answer. And you know, on that point as well, it's I don't know, and I'm struggling because I haven't been advising clients anymore, so I'm not facing clients or anything like that. But there has been advisors who's been extremely vocal about take your money out of South Africa. Almost beating the drum to the effect that this is another Zimbabwe situation and things like that. And they've been very, very vocal about get your money out of South Africa, like not through asset swaps and that, get it out, like through the Reserve Bank and get your money out. And I look at, you know, I mean, particularly when everything tanked so much and it tanked more than offshore did. And obviously the rand that weekend obviously helped cushion a lot of the downside of the offshore markets as well. And that's something we shouldn't forget. It looks better there, but often the rand is the thing that makes that big difference.
Yes,
and it can just as well work against you.
When you count your money in dollars, it doesn't look that great. You may be down 30 or 20% or 14%. Many managed funds offshore, the average balance fund still to this point is probably down 13% year to date in dollar terms.
Yes. And the thing is, you know, if you want to use that money in South Africa, you got to bring it back at some stage. It doesn't help you having money offshore, and you can't go there to go and use it there. You know, so that's I don't know. So those are some of the questions that's running in my mind. But I want to know, sort of from you, you know, is that the right call? And I think about everything that we've spoken about, the principles, diversification, timing the market. You're saying that, you know, just have less risk assets at the moment than other things. You know, don't go even if Reg 28, for instance, allows you the 75%. You know, don't do that. Particularly, still be cognizant of what's going on right now. But part of that, you know, should we have gone offshore? Should we have stayed? Is it okay to have stayed? You know, did we miss the boat? You know, where are we?
Look, I think if you were offshore and if you are offshore, it's still a good place to be. Like, just from an opportunity perspective, there's more opportunity for investors globally. I mean, we're 2% of the world's market capitalization in South Africa. And remember, in South Africa and on the JSE, they've got really good companies that are global. They are competitive globally, so you can still make money by actually investing in the JSE and Naspers and BAT, and these guys are examples of that. So coming back to your question, I think for growth assets to have a sizable investment offshore or even via your local list and your local portfolios are advisable because of the opportunity set. For income investors, clients who need to generate income and make a living in South Africa and have your milk and honey here, South Africa still offers a very attractive yield. So I would certainly think income investors should stay at home. And while you live here, you should clip the ticket in terms of the yields you obtain locally. And then growth assets, I will certainly think you need to have a sizable chunk offshore just because of the opportunity set. But I have to give you a health warning, and all those advisors that say take all your money offshore. If somehow, just somehow, we get our economy right, remember, all and most of the bad news is priced in banking shares, retail shares, listed property shares. And yes, it can get worse. I get that. And it's probably close to the worst that we can imagine. Having a lockdown in South Africa after our economy was in dire straits already is really disastrous for our economy and for those stocks. But most of the bad news are priced in. So when we have any form of recovery, any form of good news, these stocks have between 30 to 100% upsides, gentlemen. It's got a lot of upside potential. If you ask me, what wakes you up at night most in terms of your portfolio at the moment, is the fact that I don't have enough banks and retailers, and maybe to a degree listed property, because we have very little at the moment. If that recovers with 30, 40%, we will look extremely stupid as fund managers. And the Allen Greys and Coronations will look very good because they hold them because they're too big. They can't actually, I won't say they can't sell them, but they were buying them since last year. They were buying them in February and they tell us they're buying them again. Not Allen Grey, more Coronation. So you will look stupid as a client or as an advisor if that happens. And my humble opinion is it will happen. You will get your 20, 30% again in these stocks, that upside. So you've got to have some exposure to SA Inc. It's really priced in for complete permanent damage. And yes, it can get worse. But anything downside from here, we will probably pick up the tab and buy more of it. But again, you've got to be selective. Not all property companies are going to survive this. Not all banks are going to be profitable. So your stock picking is going to be very important. We are proponents of indexation. We love indexation. It comes at a small cost and you have to buy the market, so you might as well get it cheaply. But even there are challenges. You can't just buy a bond index or equity index anymore. There's a lot of casualties in that index that will not necessarily recover. So that's where we now use more smart indexation in our portfolio. So quality themes and momentum themes, where the process of these index providers will actually pick the quality companies and those with price and earnings momentum and also price momentum. So from an indexation perspective, also a message: just don't buy the beta funds anymore, because there are casualties. There will be casualties in that, and it may underperform. So there's a definite opportunity for alpha managers or active managers to outperform the indices from here. Naspers is their big Achilles heel. Naspers, 20% of most of the beta indices are still causing the beta indices to outperform many advisors. Not advisors, many alpha managers or equity funds. So what I'm saying is there's still a lot of opportunity locally if we get our economy and if we recover our economy. Our president's got a wonderful opportunity to set things straight in the next year or two. This crisis has given him a new opportunity, and that remains to be seen. I think the next 3 to 6 months will provide answers to that statement. It's whether he uses the opportunity to set things straight, whether it's people getting jailed, sending the right message across, and actually doing something about the SOEs, making them either getting rid of them and making the tough calls in terms of retrenchments and making them healthier going forward, and actually making the right decisions to stimulate our economy and our tax base. That's very important. At the moment, it looks quite bleak. I have to admit, it's hard to be optimistic, but South Africa seems to always recover from all the challenges that we've had. If you look back over the last 100 years, there's been many challenges before from a global perspective and a local perspective. We think that the developed markets will recover from this quicker than emerging markets, because emerging markets has less tools to deal with the economic recovery. There are less reserves, less monetary tools relative to the global developed markets. So that tells you we stick to our offshore growth assets, but locally there will be opportunities. There are opportunities, but at a lot of risk.
Yeah. All right. Just quickly, so I mentioned to everybody yesterday that we have another guest coming onto the show talking about financial management and that kind of stuff. So that's been confirmed now. Next week, Tuesday, will be when we're going to be talking about that. I'm going to be joined by Johan Vosloo and by Martha Kukamur. They are from ComSpace, and we are going to talk about all the different trends and things that they see and all of the things that one could do, and the benefits of really managing all of the flows in your business correctly, and knowing that. So that's going to be a very, very interesting conversation. I've had many of these conversations with you particularly before, and I think that's going to add a lot of value, because we've been spending a lot of time on the value in our businesses and how we do marketing and all the kind of stuff that goes around that. We spoke about pricing models and all sorts of stuff, but I think managing our money really well is really, really important, and understanding where everything comes from and how we can make our business more valuable and base business decisions on those data. That's going to be fantastic. So I just wanted to let you know about that. I want to get into, Roeloff, some questions quickly from the people. I don't see any questions here on YouTube, but I want to look at LinkedIn. I know that there's been quite a few comments and things going on, so I'm not going to read the comments. I just want to see if there is particular questions over here. Peter Stradom said many of the investment principles apply equally in both the capital accumulation and decumulation phases. When you are drawing an income, another principle and risk rears its head, and that is sequence risk. Absolutely. And sequence risk is a very important thing when you start off in retirement, right? It's not really a thing that later on. It's really a thing that you need to consider at the start of retirement. That's very, very important. So I want to...
And again, the role of the financial advisor is big there, to coach the client to make the right decision on behalf of the client.
Yes, absolutely. Shlanganani says he hopes that the money I'm not spending is now compounding. Well, yeah, that's assuming there's still the same amount of money coming in, Shlanganani. Can Roeloff please mention the specific risks? So this is from Neil Phillips. Can Roeloff please mention the specific risks client may face in RSA retail bonds, as this is very topical? Thanks.
It's simple. If you think the government's going to repay all bondholders, not your 500,000, not your million, all bondholders. Guys, we're sitting with a very tough situation with the land bank at the moment. You will see the emails come through from certain flexible income managers where they've decided to write down 30% of the net asset value of their bond holding in land bank, due to the fact that land bank has actually called a default on maturities that's due now at the end of April. So there's a lot of, Future Growth has made a big statement that they want to assist, but they don't have all the capital that they require. PIC, government, everybody has to now jump in and actually assist the land bank to stay afloat. And I can't underline how important this is, because 50%, 60% of the land bank is about farmers and their loans. So think about it. Think about the implications of proposals on land reform. This is serious. So the point is, even with a corporate, you when you buy a flexible income manager, 10, 11, 12, 15% of that corporate, of that flexible income manager, Coronation, Abex, Prescient, wherever, are buying corporate bonds. So it's whether it's a property company, whether it's Mercedes, whether it's a bank. The bank doesn't fall into that category because they much the bank balance sheets are good, but there's no more issuance in corporate debt in South Africa because there's no demand. Bonds are all about supply and demand. So when your perception, let's take it globally, when your perception is that South Africa is not in a great financial position, will you as a European bond manager buy the 11% and stay there for 5 or 10 years because you've got full confidence that South Africa will repay your bond? The answer to that question, unfortunately, is they may see it as an opportunity, but they see it as a trading opportunity. Get in, get your coupon, and before your 5 years expired, get the hell out, because I'm not so sure whether I'm actually going to get my bond repaid. So that's the attitude of the global investor. Now, the people, which is quite funny, it's not funny, it's actually quite scary. The people who actually want to invest in the SA retail bond are, some of them, I shouldn't actually be judgmental, but some of them criticize the government daily, criticize everything that happens in this country daily, but they were willing to put 100% of their savings, or 50 or 100, into that pot that they're criticizing with that leadership, and think that they're going to get the 11%. Guys, you've got to understand your risk here. We have 10% in our Rec 28 portfolio in that environment. We have, because it's a short-term good opportunity. Do I tend to stay the 10 years? I have to be honest. When I make enough money and when the yields come back to 9 or 8%, I'm out of there. I don't need to assume that risk. Why? So it's not a slam dunk. It comes back to the one-horse race theory. It looks like it's a one-way bet, but if that horse jumps the fence, your money's gone. It's gone. It's back.
Yeah. All right, Roeloff, if people want to know more about MitonOptimal, where can they find more information?
I suggest email George at MitonOptimal.com. He's the head of sales. It's an easy name to remember, George. George at MitonOptimal.com, or Waldo at MitonOptimal.com. He's in Pretoria. Waldo is WALDO, or George at MitonOptimal.com. It's .com because we're international, not .co.za.
Yes. Sure. Okay. No, awesome stuff. Roeloff, from my side, thank you very much for being here today and for sharing all of this. I think it was a very nice conversation. It was easy to follow, easy to understand, because that's what often happens, is that people in your position will talk your language and then people don't always follow. So I must commend you on the way that you've done this. I followed everything that you've said. It was amazing. It was great to get to meet you and to get to know a little bit more about you, and then also to sort of see, where we are today. And obviously, I mean, we can have this conversation for another 3 hours. But from my side, thank you very much. I really appreciate it.
Stay safe, everybody.
Thank you very much, and I hope to speak to you again.
Take care.
Thanks.